Hello and welcome to this free video course, Company Valuation 101. Just to give you a quick introduction, my name is Oliver James and I'm the founder and CEO of Freeman Publications. And this course is just going to expand on chapter 7 of 20 for 20. Because as you may have read in the book, it's very difficult to give a company valuation model in book form. So we've decided to do it in this course, and just to state, it is completely free. There's nothing for sale inside. All the resources are given to you at no cost. So we're going to cover the theory behind the model, which won't take too long. This will just be this video lesson. And then the model itself, which is the actual calculator we would use to value a business. And there are two variants of that calculator. One to value a business that is profitable, and then one which is a modification of that we would use to value a business that is not yet profitable. So that's what we would use for more high value growth stocks and newer businesses who have become public. And the reason we've had to do that is because the traditional model of value investing, which is pretty much the one that stemmed from security analysis by Ben Graham, it doesn't necessarily work in today's climate, in the sense that in Graham's time, there were very few companies that went public before they made any money. Whereas today, we see that more and more. And we see companies operating at a loss with giant valuations. And so if you go strictly by his model, you just can't apply it to companies that don't yet make money. And so we've had to make some modifications to that, and that's what we've done. But first, let's cover the basics. We'll start with this quote from the legend himself, Warren Buffett: "Valuing a business is part art and part science." That could not be more true. So the art part of this equation is what we covered in chapter 4 of 20 for 20. That's where we sort of outlined our rational process investing methodology. And this is the start of the equation. You start with the art part and you finish with the science. And if you've already read chapter 4 of 20 for 20, you will understand the factors we would use in our methodology. But it really boils down to two things, and that's your knowledge of the business. So that's things like moat and competitive advantage. It's intangible assets, so stuff that cannot be measured on a balance sheet. So things like intellectual property, things like brand loyalty. And then your knowledge of the sector that the business is in. So industry trends, supply chain practices within the sector, any specific nuances to that sector that might not be apparent to someone without knowledge of it. Then we move on to the science part, and that's what's covered in chapter 7 of 20 for 20. And that's what we're going to focus more on in this course. And that is, there is no perfect formula. If there was a perfect formula, we would all just use the same one. But there is no perfect formula for valuing a business. And the formula itself is the end of the equation, not the beginning. And many, many new investors are getting this wrong, especially in the current market climate, where we've just come out of a 10-year bull market. One of the strongest 10-year markets on record. And now, as I'm recording this, it's currently May 31st, 2020. Now there's a lot of uncertainty. We experienced a big correction in March, and we've since experienced a rebound. And now there is much question to whether we will go into a full-on bear market or whether the market will continue to rally. And the reason I'm bringing this up is that we're seeing a lot of investors rushing into companies purely based on they believe the company is good value, but what that actually means is the stock price is cheap and they think they're getting a bargain. We're seeing that with companies like American Airlines, like Carnival Cruise Lines. And if you understood that the formula is the end, not the beginning, you would never do that. I'll explain why later on in this lesson. So the science part, like the art part, if you really distill it down, it just comes down to two factors. And that's future growth potential of the company, and there's margin of safety. And I will elaborate further later on. But first, I want to show this chart. Now, this is the most popular stocks owned on Robinhood. And if you're wondering why I'm using Robinhood as a metric here, because it's the biggest signal of what newer retail investors are doing. And so these are the 100 most popular stocks. And in this image, we've got the top 11. So the 11 most owned stocks by people with Robinhood accounts. So number 1 and 2, we have Ford and General Electric, pretty solid companies. 3, Disney, company we recommend in 20 for 20. And then we have, this is where it gets interesting. Number 4 and 5 are American Airlines and Delta Airlines, respectively. And anyone who follows rational process investing would never touch these two, especially with the current climate. And then as we go further down, we have Carnival Cruise Lines coming in at number 8. And at number 11, we have Norwegian Cruise Lines. And like I said earlier in the lesson, people aren't buying these based on future growth prospects. They're buying them because, oh, the price is cheap. And that's not how you value a business. And here's why. Past results are only useful to an extent which they give you an insight into the future. And this phrase, to an extent, is the key. Past results are not a true indicator of future results. Sectors change, trends change. In the early 1900s, railroads were the best investment ever. Railroads were the big growth industry. That is no longer the case because of changes in technology, changes in sector trends. And just because something used to be X price, then it has to go back to that price is not a strategy. That's not how it works. Companies can go to zero. Companies can lose their value for decades. It doesn't always bounce back. The market overall bounces back. Companies don't. That's not how it works. So if the company's future is completely uncertain, then do not invest in them. I have them here. American Airlines, Carnival Cruise Lines. Luckin Coffee is another one. This was a big favorite of the high growth, not much interest in the fundamentals of the business model crowd. Earlier this year, it lost, I believe it was 83% of its stock price in a single day after massive fraud was uncovered. And since the CEO and COO have been forced to resign. And what happened after this 83% drop? Everyone was flooding in. People couldn't wait to buy Luckin Coffee. They thought they were getting an absolute bargain because the price used to be $50 a share and now it's $7. Everyone's going crazy. But the fact is that $50 a share was because of results that weren't real. So that's not an anchor for what the price should be. That is based on lies and fraud. So just thinking, okay, it's 50 and now it's 7. Hopefully it will go back to at least 25. That's not a strategy. The fundamentals of the business were compromised. So therefore, past results are not useful at all because they don't give us any insight into the future. Let's take a look at this chart now. This is the Nikkei 225. This is the index of Japan's stock market. And this is a almost 40-year chart. So that's 37 years on the chart. 1981 to 2018. Sorry, 27 years. My math is off. And we have the giant 1980s bubble in Japan's stock market. So while the Dow Jones went sideways from the 60s to the early 80s, the Nikkei increased eightfold over the same time span. And it was the strongest stock market in the world by the end of the 80s. And then we had the crash. We had the early crash, which was kind of Japan focused, but the entire world felt that in the late 80s. And then we also had the Asian currency crisis, which began in 1997. And so, as we can see, from 1989 to 2003, that's a drop of about 80%. And then once again, in 2009, in the financial crisis, hits a new low. So then from 1989 to 2009, 20-year period, that's 82% from its peak. So imagine you bought at the peak in 1989, held for 20 years, you've lost 80% of your money. There has been a rebound since then, but still, this chart goes up to 2018. I don't have the exact figures for what it was a couple of months ago when everything else was at the peak, but it was still less than 38,000. So still, in almost 30 years there, you've lost 40% of your money. So just because something was once a certain price does not mean it's going to go back to that price. And that is very, very important when analyzing individual companies. And that's why you cannot place a total focus on past growth. So let's cover margin of safety now. The second most important point of the science part of valuing a business. And the easiest way to define margin of safety is to use a metaphor of driving distance. When you learn to drive a car, you get told that you should stay 2 car lengths behind the car in front of you. And that's so you have time to react if something goes wrong. So if the car in front of you slams on the brakes, you have time to react so you can slam on the brakes too, and you avoid an accident. But the more inexperienced you are as a driver, the further the distance should be from the car in front of you, because you have less experience doing this. Therefore, your reaction times probably aren't as good. You haven't experienced this scenario before. Therefore, you should give yourself a bigger margin of safety. The same goes with if you're an older person, say you're in your 80s, and just your physical reactions are not as sharp as they used to be, then you should increase the distance. So you give yourself a bigger margin of safety. If you're a professional driver, say you're a NASCAR driver or a Formula One driver, then yeah, you can probably get away with 1.5 cars because you have better reactions than 99.9% of the population. So you see here, margin of safety is not fixed. You cannot apply a flat number to margin of safety. And margin of safety varies in investing with your core competence. So just to go back to the NASCAR analogy, if you're the CEO and founder of a public company, your margin of safety should be 0, because no one should know more about that company and its future growth prospects than you. So if you were to give yourself any margin of safety, you would be saying, look, I just don't know this business, which is my business, is the one I own. And if you're in that position, you probably shouldn't be the owner of the business. So the further away you get from that position, the larger your margin of safety should be. So we're not all founders and CEOs of public companies. In fact, I doubt anyone watching this is. So in practical terms, for a retail investor, margin of safety comes down to your experience in the sector and your knowledge of that company and the sector it's in, and then your level of personal risk tolerance. So let's say hypothetically you've been working at General Electric for the last 20 years and you're working in the finance department. So you know all of the different subsidiaries that make up GE, you know about the profitability of all of them, you know about the future growth prospects of the company. Your margin of safety is very small. If you're someone who doesn't have much investing experience and you read on the internet that GE is a good investment, then your margin of safety should be pretty large because your experience in the sector is zero. Your knowledge of the business is very small, and therefore you need a large margin of safety because you might be wrong. And the chances are, if you're investing purely based on tips you found on social media, you're going to be wrong a lot of the time, because as we explained in 20 for 20, investing off of social media chatter and tips from friends is the worst thing you can do, because there's no basis for it outside of someone's personal opinion. And then your personal level of risk tolerance. Once again, this isn't something that you can apply a formula to. You just have to be honest with your own situation. If you're 18 years old and someone's given you $5,000 to put into the stock market, your personal risk tolerance is going to be pretty high because you have 50 years of potential earning in front of you. And, if you lose all of your $5,000 in the next year by investing in terrible companies, it's not going to put a big dent onto your financial future. However, if you are 70 years old and you're using your entire retirement fund to invest in a particular stock, which I do not recommend, then your personal risk tolerance is so slim. And if you are going to do that, you should have the best knowledge about the company possible. Your margin of safety is so small. So in the next lesson, we're going to use actual numbers for this. But margin of safety in practical terms, we use a percentage. And we use that percentage to help you understand the difference between the fair price to pay for the stock based on our valuation model, and we then subtract the margin of safety from that to account for the times you are going to be wrong. And that gives you your personal level of this is a fair valuation for the company based on my own risk tolerance. And that is the best way we've found of valuing businesses using this margin of safety concept. If you are interested more about the theoretical basis behind margin of safety, then I would recommend getting The Intelligent Investor. It's chapter 20 in that book, which is the last chapter. And I have mixed opinions over The Intelligent Investor. I think it's the most overrated book in investing, but it's definitely worth the money just for this chapter alone. Because if you can really understand and internalize that concept, then you're going to be ahead of 95% of retail investors. So yeah, if you're interested more about the theory, chapter 20 of The Intelligent Investor. But now we're going to go on to the actual how-to of valuing businesses. So the next step is the link in the description for this video is freemanpublications.com/valuation sheet. And that will bring up a Google sheet. You don't have to enter your email again or anything like that. It will just come up in your browser. And then we will show you how to use that sheet to value a business. And one more thing, by using that spreadsheet and using the resources we recommend, you don't have to pay for any sort of stock screening services or anything like that. You can just use the numbers that are publicly available, and they're available on free websites like Yahoo Finance or MSN Money. And then you can accurately value the business using this formula from those. So just click the link in the description, and the next lesson will be how to use that valuation spreadsheet.